With the One Big Beautiful Bill Act signed into law on July 4th, 2025, the government is introducing the first ever federal child savings account, known as Trump accounts. Concurrently, we're seeing the ongoing rollout of the Secure Act 2.0 Act and the FAFSA Simplification Act, which affect the rules for 529s, custodial Roth IRAs, and ABLE accounts. While politically expedient, these new programs add an additional layer of complexity to an already complex savings system. Choosing between account types has never been more difficult. Hence, why you need to understand the actual mechanics of these vehicles. We're going to review how these accounts interact with taxation, flexibility, and control. And hopefully, in a few minutes, you will have the knowledge to choose which account is right for your child. My name is Eugene Hoover. Thanks for taking the time. Trump accounts are a unique account type. They combine elements of traditional IRAs with a strict minor only growth period. If your child was born between January 1st, 2025 and December 31st of 2028, the federal government will hand you a one-time tax-free $1,000 seed contribution. But it's not automatic. To claim it, parents must file IRS Form 4547 or register on trumpaccounts.gov. To get more cash into the system, the Treasury launched the 50 State Challenge. Some heavy philanthropists and corporations stepped up, including the Dell Foundation, Dalio Philanthropies, the Indiana Pilot, state level subsidiaries, and corporate benefits. This is free money. So if your child qualifies, even if you plan to focus your savings in a different account type, consider registering for it. In terms of saving in a Trump account, you can contribute up to $5,000 a year of after tax money. Employers can contribute up to $2,500 per year, but those funds count towards that same $5,000 limit. Unlike a Roth IRA, your child does not need earned income to qualify. There is a catch. During the growth period from birth until age 18, your investment choices are locked. The investment funds must track a qualified index of U.S. equities like the S&P 500, and also realize that the money is illiquid. You cannot touch it for any reason during the growth period, except in cases of death or if you roll it into an ABLE account for a disabled child at age 17. On January 1st of the year your child turns 18, the account automatically morphs into a standard traditional IRA. This is where the tax trap springs. Because you are commingling after tax personal contributions with pre tax government seeds and employer matches, you hit the IRS pro-rata rule. Every withdrawal will contain a mix of taxable and tax free cash. And if your 18-year-old decides to cash out the account early to buy a sports car, they'll face ordinary income taxes and a 10% penalty on the pre tax portion and all earnings. Keep in mind that traditional IRAs do have exceptions to the 10% early withdrawal penalty. Nonetheless, this account is ideal for saving for your child's retirement. If your primary goal is college tuition, the 529 plan is still the gold standard. Recent policy changes have officially remedied the grandparent loophole. Under the old FAFSA rules, grandparent owned 529 plans were ignored as assets, but the moment they distributed cash for tuition, it counted as untaxed student income. The formula penalized student income at a brutal 50% rate. A $10,000 distribution would slash aid eligibility by $5,000. The recent FAFSA Simplification Act fixed this. Grandparent owned 529 distributions are now completely invisible on the federal form. You get tax free growth and zero aid penalty. Just be careful with private colleges. Over 200 institutions use the CSS profile, and they still look at grandparent held assets when calculating institutional aid. 529s have also been made more lucrative with recent legislation. It is important to take a detailed look at the details, but 529s can now be used for K through 12 education and trade schools and apprenticeships. But what if you accidentally overfund your child's 529 or end up not needing it? In addition to having the option to change the beneficiary of the account, there's also the new Secure 2.0 Roth conversion. If you overfund a 529, you can roll up to $35,000 of leftover money into a Roth IRA for the child. But the rules are tight. The account must be open for 15 years. You can't roll over contributions from the last 5 years, and transfers are capped at the annual Roth contribution limit of $7,500 in 2026, requiring the child to have matching earned income. In other words, 529s are still unmatched when it comes to saving for education expenses, and if you overfund the account, you do have options. Custodial Roth IRAs can help your child utilize their early working years to kickstart tax-free compounding, but you must clear the earned income hurdle. Your kid must have documented bona fide wages, babysitting, mowing lawns, or working for your own business. Parents' allowances do not count. Contributions are capped at the lesser of earned income or the annual limit, which was $7,500 in 2026. The beauty of the Roth is tax-free growth. You can withdraw the original contributions at any time for any reason with zero tax or penalty. Tapping the earnings before age 59 and a half is usually a bad idea, but the 10% penalty is waived if the cash goes to fund college tuition. Just watch out for the FAFSA trap. While retirement account balances are hidden on the FAFSA, the minute you take a distribution to pay for school, it counts as untaxed student income. That distribution can slash next year's financial aid package by up to 50%. Nonetheless, these accounts are a great way to teach your child who has income how to save, and many parents who use this account type will recommend that their child save a portion of their earnings and then match that saving in the custodial account. If you want simplicity, custodial accounts, UGMAs, UTMAs, have historically been the choice, but they carry a massive asset control and potential tax problem. First, understand the legal structure. UGMA is limited to bank cash, stocks, and mutual funds. UTMAs go further. You can put real estate, vehicles, patents into these type of accounts. These are irrevocable completed gifts. You cannot take the money back, and the donor should not be the custodian. If you name yourself custodian and die before the child is of age, the IRS pulls those assets straight back into your taxable estate. The real issue is the transfer of control. Once your child reaches the state's age of majority, typically 18 to 21, the money is unconditionally theirs. They can buy a sports car or fly to Vegas. You have no say at all. Then there's the kiddie tax. Congress designed this to prevent parents from shifting high-yield assets to their kids' lower tax brackets. For the 2026 tax year, the brackets are tight. A $50,000 UTMA balance kills aid eligibility by $10,000. In parent-owned 529s, it only drops aid by $2,820. If you're stuck in this trap, there is a workaround involving reinvestment into a custodial 529, but make sure you research it before you do it. Let's briefly touch on some specialized tools. For example, Coverdell ESAs offer tax-free growth and cover broad K-12 and college expenses. The big win? You can self-direct the investments into individual stocks. The downside? The contribution limit is stuck at a measly $2,000 per year per beneficiary, and it is not adjusted for inflation. You can tell that this account type was created long ago and has not seen any recent updates. High-income earners get phased out starting at $95,000 if you're single or $190,000 if you're married filing jointly, but there's a workaround. You can gift the $2,000 to the child and let the child make the contribution. Just be sure the money is spent or rolled over to another family member by age 30. If you are transferring serious wealth, forget UTMAs. Consider an irrevocable trust with a crummy provision. Keep in mind that this is a complex and irrevocable estate decision, and normally gifts to an irrevocable trust don't qualify for the annual gift tax exclusion, which was $19,000 in 2026, because the beneficiary does not have immediate access. A crummy provision solves this. It gifts the child a brief window, usually 30 to 60 days, to withdraw any new contributions. Once the window closes and the right lapses, the money stays in the trust under the trustee's control. It converts a future interest gift into a present interest gift, shielding your lifetime exclusion. And finally, ABLE or ABLE accounts, which is IRC Section 529A. If your child has a disability, this is a phenomenal tool. Thanks to the ABLE Age Adjustment Act, the age limit for onset of disability rises to 46 in 2026, opening the door for millions of families. The standard contribution limit is $20,000 for 2026. The One Big Beautiful Bill Act permanently extended the able to work provision, allowing employed beneficiaries to contribute up to $35,650. Even better, up to $100,000 in an ABLE account is completely disregarded for supplemental security income or SSI asset limits, and Medicare eligibility is untouched. My name is Eugene. Thanks for your time.